the bank's biggest problem is when there isn't credit offtake happening, what to do with the liquidity. So what they will do is they look at their liability side. So to that extent, they would cut deposit rates. And what would happen automatically, or just creating conditions for financial repression?
RBI had chosen to infuse liquidity and push for a rather aggressive reduction in interest rates, both on its part and also on the part of commercial banks and other retail financiers. But the economy might not just be ready for this.
It's always good to keep the powder dry. So we don't know what's going to happen in December. And you have conditioned the markets that 5.5 is the terminal rate. Now, nobody stops RBI from cutting interest rates later also, but everybody is, you have said that the space for more cuts is not there. And then you cut, it will again be a question of credibility. So might as well it is easier, and if it is everybody understands that you do it in gradual stages, and then you keep options open.
Hello and welcome back to Tracking Trends. By now, you must have read, you must have watched the Reserve Bank of India sprung quite a few surprises when its Monetary Policy Committee meeting concluded on Friday, that was yesterday. That the Reserve Bank of India would go for another round of cut in its benchmark lending rate, called the Repo rate, was expected. What was surprising, to some at least, that in place of a 25 basis points, the Reserve Bank of India chose to front load its rate cuts and announced a 50 basis point cut in repo rate from 6% to 5.5%. With that, in the past 5 months, the Reserve Bank of India has effected a cumulative 1 percentage point cut in repo rate. But the biggest surprise was the reduction in the cash reserve ratio from 4% to 3% in 4 phases between September and November. So by December, an estimated 2.5 lakh crore rupees would have come into the banking system fresh. The last surprise, and also in a way rather confusing signal that came from the Reserve Bank of India, that in April, when its Monetary Policy Committee met, it said it was shifting from a neutral to accommodative policy stance, which meant that the Reserve Bank of India would have a bias for softening interest rates in time to come. But within a quarter, yesterday, it announced that it was moving back to the neutral stance, which many found rather perplexing. Now, to get a bigger picture and to get deeper into the announcements and understand its ramifications, this episode of Tracking Trends focuses on the announcement made by the central bank and the thinking and reasoning that could lie behind it. And to do that with me is my colleague Kalyan Ram, who is the founder of basispointinsight.com. It's a new portal focused on policy insights, deep dive analysis of how markets behave, how markets respond, and more so, he keeps a close watch on the central bank. Welcome to Tracking Trends, Kalyan. All the Tracking Trends also gets published on basispointinsight.com, which has been founded by Kalyan. This is the first time Kalyan himself is sitting across and talking to us on an issue that everybody is interested to know. What's going to happen to my home loan rate? What's going to happen to my auto rate? What's going to happen to my fixed deposit rates? More importantly, on a bigger scale, what does one expect about inflation, growth, etc., etc. Kalyan, take it over from here and tell our audience how do you see the announcements that RBI made yesterday?
Thank you, Rajesh. Thank you for having me. It's a difficult question in a way to answer. Uh, Till yesterday, when the announcements were made, it was fairly easy because we were focusing on what the announcements were. The fact that the magnitude of the announcements surprised everyone. Uh, but having slept over these decisions, now it is becoming a little difficult to classify how to characterize this particular aggressive monetary easing of the Reserve Bank of India and the reasons why they have done it and what are the broader implications of RBI front loading weight, I mean, to the extent that it did. Somebody was saying it is something like front overloading, not just front loading. So, the second day today, it is probably a little difficult to classify what exactly is the RBI's game plan. On the face of it, it looked very simple. The RBI wanted to take advantage of uh, the fall in inflation. I think the disinflationary trend is holding and is likely to hold. And then, as it did in the previous policy in particular, that RBI is seeing a space for supporting growth. So to that extent, it has cut interest rates, and everybody was expecting that RBI would cut interest rates by 25 basis points. But what it
Were
did,
you, were you also expecting that it would be limited to 25 basis points?
yes, I was expecting it to be only 25 basis points. And I was expecting that in August, there will be one more 25 basis points. And that would probably be, in some ways, a terminal rate, unless situation really warranted much more deeper cuts later. RBI would have acted accordingly. But I was thinking, in line with what everybody else was expecting, that it will be at 25 and another 25 in August.
So why do you think that RBI chose to, um, so to say, advance or front load, as they say it, this another 25 basis points? What do you think must have been the thinking?
So there are two parts to look at this. One is that RBI has also been giving a lot of liquidity. I think from December and particularly from January onwards, the liquidity operations have been quite profound. The thinking is that RBI is seeing a rate cut and RBI is seeing a easing policy because inflation has come down. So the thinking is that if I see a rate cut, why not do it now, and why to wait for a very long time? I think that is time tested in the sense that if they are very clearly seeing a rate cut ahead, they might as well do it and not keep it for a very long time. So that is one thinking which is not surprising. But what is surprising was that, in one way, one can say that what surprised the markets were that RBI has already taken action or has been taking action since February. The system is adopting to or adapting to the new easing cycle and the infusion of liquidity. Short-term interest rates have come down, and then suddenly there is a jolt that there is a 50 basis point cut, there is a promise of a CRR cut coming in the future, and all this to support growth. Now, it is a shock in the sense that how to deal with this kind of liquidity. See, at this point of time, the main problem is that banks have liquidity, and the question that is prevalent in banks' mind is that, listen, is it liquidity or just the cost of capital which is resulting in credit offtake not picking up as much as one is expecting it to, or is it that demand conditions or demand for credit is not very high? So the problem the banks would face is what to do with this liquidity,
So
because
what
organic growth and demand for credit has to happen on its own, and then monetary policy cannot artificially create this demand. It can be a facilitator. When demand is there, there will be enough liquidity, uh, 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 good level of interest rates where people are encouraged to borrow and spend.
So
Yeah.
what basically you are saying is that even if you have enough money in the system to lend, which is in a technical language, even if you have enough liquidity, and even if you bring down the cost of funds by reducing interest rate, that still doesn't guarantee that growth would get boost uh, if there aren't enough bankable projects. The banks and financial institutions don't find bankable projects, and they won't find that bankable projects because investors and industries are not confident about taking up new investment, and they may not be confident of taking up new investment because they may not be foreseeing enough spike in demand for what they are going to produce, right?
That
so
is
so what you are in essence saying, that the RBI had chosen to infuse liquidity and push for a rather aggressive reduction in interest rates, both on its part and also on the part of commercial banks and other retail financiers. But the economy might not just be ready for this. Is that what you're trying to say?
absolutely, that is what I'm saying. See, if you look at, see, there are what has happened in the last few years, especially post COVID, is that one is not a lot of theories have been challenging, have been challenged, uh, and nobody is very sure how things will play out. Most of the theories are getting tested. So it remains to be seen if the RBI's game plan will work or not work. But on the prima facie, a lot of people, especially everybody, is a little worried as to what exactly is RBI trying to do. What works best in an easing cycle is that there is a carrot of more cuts. Then you let the markets front run the RBI in an easing cycle especially, and that works best because system there is time to adjust, and then one is expecting lower rates, and therefore the economy is adjusting to that particular thing. Now with suddenly so much coming in and with nobody expecting, and then also remember what the RBI has done is that it has said it has changed its stance and
Hmm.
it is suggesting no more rate cuts.
Yeah.
So what probably could have worked better is you give 25, there is a chance for another 25, you take more time, system is already adjusting to the past rate cuts, then the transmission is and will happen as liquidity improves, as markets are adjusting to the lower rates. It's already evident short-term rates had come down. Now suddenly it appears it's too much. One is not sure what to do with liquidity. And usually when one is not sure with liquidity and there is no organic offtake in demand, then obviously banks will push for credit. And what would happen is that there will be asset price inflation. It'll go into channels where one is probably not really chasing or targeting at this point of time. Those sort of things would tend to happen. And
Yeah,
from a communications perspective, I think this is important, which is what has actually surprised everyone, is that RBI has just changed the stance last in the last policy to a accommodative stance. Now, suddenly, a few weeks down the line, they have changed it back to, uh, they've tightened the stance in that sense to neutral. Anything can happen, but uh, but the question is why? They could have done a 25, or even if they've done 50, they could have just left the stance open.
Mhm.
So this flip flop is something which is again creating a lot of confusion. I may also want to point out that one of the MPC members has only has dissented. I mean, you had interviewed this person earlier. That person wanted only 25 basis points, and
Mhm.
then even in the previous policy, that person had was convinced that RBI is not committing to continuous cutting of rates. He had
Mhm.
some dilemma with regard to should the stance be changed to accommodative.
Yeah.
So I think we'll have to wait for the minutes to see what exactly RBI is trying to do. But
Yeah.
prima facie, it just appears that they see a narrow window because inflation is well behaved. So might as well do whatever they can do to support growth. That seems to be the mantra.
Yeah, right. You're very right. Thank you for pointing out that we actually, I had spoken to Saugato Bhattacharya, who is one of the independent members of the Monetary Policy Committee. And in the last meeting itself, he had expressed his reservations about shifting the stance from neutral to accommodative. But later on, he changed his views in the meeting, and it was a consensus decision. And he had also said that the RBI, there is actually ample space for rate cuts,
Correct.
given the outlook on inflation and what's happening. But in yesterday's meeting, he seems to have batted for again a gradual and graded approach to rate cuts. So he was in favor of a 25 basis point. I hope we will be able to catch Sogoto again and have a chit chat again. But also to our audience,
We'll pull that.
yeah, to our audience, I would urge to check out basispointinsight.com, where Kalyan has written a very insightful article precisely highlighting these flip-flops and where RBI might have mishandled its communication strategy, which runs the risk of undermining its credibility as a central bank. Now, having said that, now, Kalyan, let me ask you, there is also a counter argument that this rate cut, 50 basis point, if there is a pass through, and commercial banks and retail financial institutions bring down various lending rates, be it auto loans, home loans, consumer durable loans. Uh, by it is expected that there could be a pass through of about 30 to 40 basis points, depending where you are lending. If that pass through happens now, and creates a little more disposable income in the pockets of those who have taken these loans, or encourages more people, more borrowers to come in and take advantage of these lower interest rates ahead of the festive season, could that persuade companies to step up on the investment front or on the production front? And therefore, when the festive season sets in October, December, you might actually not want to run short of liquidity should there be a significant revival for loan demand, in loan demand. And therefore, the Reserve Bank of India has lined up this schedule that between September to November, in 4 phases, it will reduce the CRR rate and infuse 2.5 lakh crore. And it is hoping that the rate cuts impact now in the July September quarter, and the liquidity infusion impact in the October November December system should do the wonder that the economy needs for a boost to the overall GDP growth. Is that a story that sounds plausible, convincing to as you as well?
See, I can say that this is a theory on which this whole monetary policy measures were based on. Now, whether it will come true or not, it remains to be seen. What would happen immediately for sure is that those loans which are linked to the repo rate would automatically get adjusted lower. And because of this liquidity, which has got a significant boost, other interest rates will also come down. MCLR will come down. So the interest rates will definitely come down. So would it automatically translate to a surge in demand for goods and services, and therefore consequently encourage companies to step up investments? That remains to be seen. Uh, One of the things that most economists say that the problem is income. Are these measures increasing the incomes of people or just the ability to leverage more? So, when unless incomes really increase, I'm not too sure if the demand or consumption will really go up. See, there is also one theoretical argument made about monetary policy. One is that monetary policy, whatever it does, it pushes growth up to the potential growth. It can't shoot up beyond the potential growth with its own measures if you just look at theoretically what it can do. So now what is required for India to do is to push up the potential growth rate even more. So I'm sure that I mean, the questions economists will keep asking is what is the fiscal policy, has it done enough to boost demand, and is monetary policy alone sufficient to do that part? Uh, Another counter argument or another point that economists make is central banking works best as counter-cyclical, at a counter-cyclical tool. So it is like it is very good to stop a party. It'll snatch away the punch bowl when things are going out of hand. That is when monetary policy works best. But on its own, will it boost growth when other aspects are not in place? That remains to be seen. Other aspects, I also would look at what is happening internationally. So, our income levels of households, have they gone up? Have they improving? Our jobs are there. I think these all factors come into place. But monetary policy creates enabling conditions with sufficient liquidity, affordable interest rates for people to go and consume more. Now, whether that will happen or not, where the impulses will come from, that remains to be seen. But the theory seems to be this, that we will front load because we see a space, because disinflation is holding and is likely to hold. Nobody is expecting core inflation to really jump. So there's a window, there is a space to provide accommodation, which is what RBI has tried to do.
So,
But the problem again is that would it giving one shot the right thing, or giving it small doses and waiting organically for things to pick up? I think those are the nuances where there is a disconnect with what RBI has done yesterday and what people were expecting.
so clearly, it seems like you would be someone who would advocate a more graded approach than this one shot uh, shock, as you explained it.
Yeah,
Um,
and then the flip flop to the stance also. What
and which is a very important thing that you pointed, that because it really leaves you wondering that one quarter down, what is the guarantee that RBI won't change its stance again?
there
So
are
it,
there are some risk factors which I would want to bring to your attention. One is that there is so much liquidity, or there is a lot of liquidity. The bank's biggest problem is when there isn't credit offtake happening, what to do with the liquidity. So what they will do is they look at their liability side. So to that extent, they would cut deposit rates. And what would happen automatically, or just creating conditions for financial repression, that
mm,
there isn't enough incentive to save, and people
yeah,
would consume because there is hardly any incentive to intend to save. So I'm not saying financial repression will happen, but I would say that this is something which economists would worry, that banks would start to look at their liability side. What do I need with the money which I don't need?
yeah,
So and this, they will take some short-term measures, but long-term it could create a macroeconomic problem. One is not very sure. So there are some risk factors which most people are there are people who are concerned about what all risks would emerge in the future. Asset price is one aspect because money has to go somewhere,
yeah,
and money will chase momentum. So, uh, but is it in line with fundamentals? Not in line with fundamentals? Those questions will remain. So that remains to be seen. And then second, when there is money which is pushing growth, it is also understood, or it's reasonable to expect that inflation will also go up.
right,
If companies are saying there is good demand, then they will pass on.
yeah,
They will pass on I mean, the price pressures will increase.
mm,
So they will also increase prices.
mm.
So to that extent, inflation will go up again. So it will be within the band or not within the band is a different issue, but inflation will go up.
Yeah,
So it won't happen that only we'll get growth and not get inflation. We'll get both.
which which I think the RBI probably is mindful of, and that could also be the reason why they have moved back to a neutral stance. That down the line you may not have a benign inflationary uh, regime.
See, I would still see a problem with the communication strategy here, in the sense that it's always good to keep the powder dry. So we don't know what's going to happen in December. And you have conditioned the markets that 5.5 is the terminal rate. Now, nobody stops RBI from cutting interest rates later also, but everybody is, you have said that the space for more cuts is not there. And then you
Mm,
cut, it will again be a question of credibility. So might
mm,
as well it is easier, and if it is everybody understands that you do it in gradual stages, and then you keep options open. You
right.
closed off your options. You close the door for more rate cuts and more accommodation by giving so much accommodation, which the absorptive capacity is suspect at this point of time.
Yeah.
So I think one is having challenges with this, and then what risk factors would emerge out of this particular strategy is what everybody is worried about.
Thank you very much, Kalyan, because if people would have read today's newspapers or watched the discussion on television, I don't think they would have found any mention of the risks that are associated, because there is literally a celebration of the rate cuts in most of the newspaper headlines, and telling people how their home loan rates could go down, their auto loan rates could go down. Of course, at the same time, the fixed deposit rates would also go down. But what you have just told us, that while the RBIs might have had a growth supporting intent, and therefore has gone uh, pretty aggressive in launching a monetary offensive, there are, notwithstanding that intent and the reasoning behind it, there are serious risks, and those serious risks might actually undo any gain that might, more than undo any gain that might come from a lower interest rate regime or higher liquidity. Thank you very much, Kalyan. And to our audience, if you have liked this discussion, subscribe to my channel, press the bell button. And if you have liked our conversation, for more of these conversations in words and text, please visit basispointinsight.com.
Thank
Thank
you,
you very
Rajesh.
much.
Thank you for having me.